This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Is all hell about to break loose in your 401k?
We hope not. But maybe it is. I don't know. It depends on what was tweeted that day, right?
This is an aggressive headline. It's just, do you ever just find yourself, it's like a random Tuesday, you're minding your business, you're trying to click through some things on the internet to get yourself some information, and suddenly you're just accosted visually by a headline, and you're like, well, what? I don't know, is it? What's happening?
Is it all about to break loose in my 401k? What did my 401k do to someone else?
This is financial advisor and retirement planner Jon Hicks. I'm Heather Branch. We're going to break this thing down, try to help you get some clarity as to what really the heck is going on. Don't forget, you can find us anytime, retirementsolutionshow.com, or click on the links we got posted in the show notes if you've got questions about your 401k and the hell that may or may not be locked inside. No, listen, clickbait's a real thing.
Of course it is.
MarketWatch is a good website, though. I like their articles.
Sure.
I feel like they put a lot of good content out. I think that I just was laughing at this headline when I first saw it, so I wanted to ask you about it. MarketWatch.com posted an article with that title. What they want to talk about, what they're bringing up, is the new offerings that if you have a 401k, you've likely heard, even if it's not being offered in your plan, you've heard about new offerings coming through. It's no longer just mutual funds or TDFs that we have options to invest in, John. Things like Bitcoin, private equity, even the option to invest in an IPO, an initial public offering. Like, think back in the day when Google first went public, getting in on that kind of stuff, John. But it does feel like this kind of stuff carries a higher risk level, maybe geared more towards the younger investors, not towards the people you work with, right?
You know, it's interesting. When I have one of the probably the biggest areas I've been really critical on 401ks is that, you don't have really any control. You know, if you look at most of the 401ks out there in the market, and I'm talking like 90%, you're going to have like 20 to maybe 30 or 40 maximum highly curated offerings, right? Mm-hmm. And they're all going to be almost the same. You're going to have your large cap stuff, your small cap stuff, your target date stuff. And that's the one I probably take the most aggressive stance against. I do not like target date funds, but when we're in those 401ks, hey, we still want to put our money away. We still need a vehicle to do it in. Mm-hmm. Hopefully we're getting some money from our company to match us if we're still that lucky to have that anymore. But I've been very critical because they don't offer very many things. This is why forever I've said, hey, as soon as you turn 59 and a half, consider taking that 401k and doing an in-service withdrawal. Put it in your own individual IRA where you've always really had, and not always with crypto, but you've always had more access to other things, right? Whether now it's cryptocurrency or other alternatives or private equity or private debt or private credit or real estate. Those things have primarily been available to us in our IRAs and our traditional, taxable accounts. Mm-hmm. But now 401ks are wanting to get in the mix. And what it is that so many of these companies have been losing money because people like me telling everyone, hey, as soon as you turn close to 60, man, let's give it some thought.
Because real quick, I'm sorry to interrupt you, but clarify, 59 and a half, that's when at that age...
It's when a certain part of the IRS handcuffs come off, and we're allowed by law to take that 401k and move it self-directed into an IRA in our own name, where we can control anything. We could have it at Fidelity or Schwab or Vanguard. Take your pick.
No tax, no penalty fee.
No taxes, no penalties, and you don't have to leave. Right. You don't have to leave your job.
Okay.
Right.
Yep.
So that's what an in-service withdrawal is. You're still in service with the company.
Okay.
You're just withdrawing the money and transferring it to your own IRA. And why do I like that? You can control your fees. Mm-hmm. You can control your investments. You can control your diversification. You can do any number of things you want, and you don't have to worry about if your 401k company allows it or not, right?
Okay.
So all of these 401k companies have been losing money. It's like, man, everyone keeps sucking all the money out. Right when they finally get that big old nest egg, that's when they're pulling it out. So now they're trying to give us some more offerings. Now, one of the things that I'm always very fearful of in these situations is when they give us the freedom to make these decisions, they don't always give us the right education.
Right. That's what I was about to say. Freedom without the information. It's not a good combination.
It's not good at all. So when you look at these things, is it terrible? You just have to be careful, right? Because a lot of these things, whether it be hedge funds or private equity or private credit, they can carry with them more volatility. Now, volatility, for most of us, we call that risk. Because it can go up 40%, but it could go down 40%. It can do it very quickly. So that is one thing to understand, that volatility is a big deal. Now, the question is, are they going to balance that in these offerings with things that give us more protection, right? Are there going to be some more protected elements in there too that are better than bonds? Because guys, I don't have to tell you, over the past 10 years, bonds have not been a very attractive investment. They've averaged less than 1.5% on the whole for the past decade. Now, who knows what they're going to do for the next decade? I have no idea. But it would be nice if they had something as an alternative in there. But here's the thing I want to focus on. Now, why are they considering adding these things?
Yeah.
No, this is a big one I did a lot of research on. As a matter of fact, Tony Robbins wrote a book not that long ago called The Holy Grail of Investing. Right? And this is where he interviewed like dozens of multi-billionaires and hedge fund managers and asked them straight up, hey, what is the holy grail of investing? And they said this, hey, we want to invest in something that gives us great growth, inflation beating opportunities, potentially more income with potentially less overall risk, or at least non-correlated risk. Those are the big four. And he wrote an entire book about this, and he focused tremendously on private equity, which is basically not like buying Walmart stock. Instead, it's what if you could have bought Walmart before it went public? Or NVIDIA, what if you could have gotten in on the infancy stages before it went public? Because that would have made you a trizgazillionaire, right? Or Google or Apple or whatever it is. Everyone says, oh man, how great would it have been had I gotten in the very beginning? Well, that's kind of what private equity is. Right. And if it goes public, then your cash out is often potentially very high. Now, a lot of companies go under too, right? Right. But the point is all these guys said, oh man, we make tremendous returns. I actually did a little bit of research on this.
Okay.
So of the 10 largest classification groups of hedge funds, historically, private equity hedge funds average double digits over the last 20 to 30 years. That's pretty good. Year to date, if you look at the market being up roughly 7-ish%, to give or take on the day, hedge funds, the better ones, are up 17 to 22% on the year. Oh, whoa. Hey, John, what are you talking about, man? So the market's been doing pretty good. Last year, how did it do? Well, hedge funds have done historically very well, or private equity has done very well. As a matter of fact, when you look at the types of companies and institutions that invest in private equity, some of the best investors in the world, the Harvard Endowment, the Yale Endowment, the University or the Texas Teachers Retirement System, CalPERS, which is the California Teachers Retirement System, all of these groups own tremendous amounts of private equity, private credit, and hedge funds. Now, why do they do that? Because they want, number one, growth. They want to beat inflation. They want non-correlated returns. And frankly, they want the opportunity to grow that money. Well, that is what potentially these things offer. But many times we may not be aware of the volatility impact. Or here's a bigger one, liquidity. So a lot of these things that are out there, my fear is that they may offer a very diluted, watered down version of private equity or private credit. But my opinion is, in those situations, you're always still going to be behind the institution that controls it. Okay. So, but here's where I go with this. But Tony Robbins said, hey, listen, if you get a 14% return over the past 20 to 30 years, like a lot of these firms have been able to do, and the market average is 9, that means you're potentially able to compound your money 50% faster, because that's nearly a 50% return more. Well, that makes a tremendous amount of sense. But my thing is this, even if they offer it in 401ks, you can still do that today. You don't have to wait for the rules to change. You can do that today if you're an accredited investor in your own IRA. You can do that at Schwab, or you can do it at any number of trust companies, or you can do it at Fidelity if they offer those types of investments you're looking for. We have lots of clients that invest in private credit, private equity, or hedge funds, as long as they're accredited, which means that you have to be worth $1 million outside of your primary residence. Okay. So if you're worth $1 million outside of your primary residence, you can do that today and look at those opportunities. But I always make sure that you already have your protection in place and you understand your income needs. Okay. Those two things should almost dictate the rest of the things we consider for our investment portfolio, right? Okay. But private credit, private equity, I think, are very sexy opportunities. I mean, it's how billionaires got to be billionaires. And it's how they maintain a lot of that, right? They don't want something correlated always with the market. They own real estate. They own the S&P. They own NASDAQ. They own things like that. They're looking for something non-correlated. This can offer that. We just want to be careful. If this is something that you're thinking about or been wondering about, if you're an accredited investor reach out to my team. This is exactly what we look at. I have for a very long time been an investor in private equity, private credit, and hedge funds personally. And I think that if you understand them, they can be an unbelievable tool to utilize for your retirement. If you don't understand them, it can make you very unhappy or unhinged, which is what we always want to avoid. But we just want to make sure we've done the right research to get to that point.
Not being unhappy, not being unhinged. Because yes, all this to say we want to invest well and do right, but you got to take the emotions out of it as well. It's like a 1-2 factor you got to consider. At J. Hagan Capital, they are here to go through these options with you, whether that's your own investment portfolio and planning, or you have offerings within your 401k that you're unsure about. We can go through a 401k x-ray to help you understand what your options are, how it may or may not work for you and your plan, because it's hard for Jon to sit here and say, you should do this or you shouldn't do this. It's not hard. It's impossible, because at J. Hagan Capital, they believe every single person is different, and so therefore you need a different plan. So let's start that conversation. You can find us at retirementsolutionshow.com. If you have questions about the different offerings and investment options that you might have within your 401k or your other portfolio accounts, we can help you get some answers. Again, it's retirementsolutionshow.com, or click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency, and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.